Hello and welcome to the AIM Research video podcast. I'm your host, Grant Collins, and today I have a special guest for you, Peter Boockvar with Bleakley Financial Group. For those that are not familiar with Peter, he is the Chief Investment Officer at Bleakley Financial Group. In his role as Chief Investment Officer, Peter leads the team that is responsible for the development, management, and oversight of the Bleakley Investment Management Program. I'm excited to have Peter on with us today. Peter, how are you, sir?
Good. Thanks for having me.
Absolute pleasure, Peter. So before I get into my first question with you, Peter, I want to maybe set the lay of the land for our listeners and then roll into my first question and your thoughts here. So I'm going to pull up a couple of slides that I've prepared to kind of give you an idea of how I'm viewing it. And I'm very curious on if you're seeing it differently. So as we close the second quarter here, I'm seeing the economy experiencing this inflationary gap. And this gap will eventually begin to narrow as policy starts to tighten and demand starts to decline, and we really start to see those financial conditions change and those inflation pressures subside. But it's going to have to come on the bounds of like lower real incomes and suppressing consumer confidence, which is what we're really starting to see now. Just real quickly to highlight some of those, we're seeing like the financial stress index from the Kansas City Fed and the financial conditions from the Chicago Fed blowing out. We've got credit spreads from high yield option adjusted spreads that are blowing out where triple Bs are staying relatively calm. And then, as I mentioned, consumer confidence falling lower as inflation pressures are rising. Peter, do you see it similarly, or how are you viewing this current economic setup?
Yeah, there's no question that falling real wages, where inflation is running faster than wage growth, is hurting the consumer. And it's whether it's changing behavior at the supermarket or the impact that higher interest rates in response to that inflation is impacting the markets, which in turn also impacts the economy through people's confidence and wealth effect that then affects their behavior in terms of what they spend. Now, higher income people obviously can absorb much better the higher inflation that we're seeing. So you're not necessarily seeing it in everyday things that they purchase, but bigger ticket items, I believe, are beginning to get affected by what's going on in the market. So it is a combination of that. And also, it's not just in the US, it's China that has taken a very strict approach to COVID, it being the second biggest economy. It's dramatically slowing growth there. Europe is likely in a recession due to this inflation/energy shock that they're having to absorb, particularly with natural gas, which is not just affecting households, but also hurting businesses that use natural gas as a feedstock. So there is a global recession that we're either beginning to enter or on the cusp of that is something that we're going to have to deal with.
Yeah, so you actually took my second question on whether or not you believe we're moving into a recession. Some of the things that I'm looking at is, let me flip back over here to the PowerPoint and flip to, it's interesting, we're still seeing a lot of the economic variables still well above trend. So one of the questions I was going to ask you is if you see this slowdown as a return to trend, or do we start to blow through trend? Like for consumption, for instance, production here, employment, of course, well above trend. And then, of course, that is keeping real GDP above trend for the time being. But the one we skipped over here is incomes are the one lone ranger that is below trend right now. So I don't want to put words in your mouth. Do you see a recession in 2022, not 2023, as some are saying?
I think there's a 99% chance that we'll be in a recession within the next quarter or two, or maybe even three. I think that it's going to be, and I see 99 because nothing's 100%. That what's going on with inflation, what's going on with this, also an interest rate shock in terms of the rapidity of the rise, which is certainly impacting the purchase of homes and also autos. That is most likely. And the reason why those numbers got above trend was not natural economic growth. It was government largesse financed by the Fed, where the government between Trump and Biden spent $5 trillion over 2 years. And the Federal Reserve bought about half the bonds that were used to finance that. So that's where we got above trend. So it was very artificial. And now we're going to give that back. So most likely you go below trend if there's a period of time that you go above it, particularly when that going above it is very artificial.
Yeah, it's like that. To use an analogy, it's like getting into the shower and the shower's way too hot, so you turn it down, and it's way too cold, so you rip it back up again, right? And we keep moving back and forth above and below trend. With that being the general base case, that's going to put a lot of pressure on the Federal Reserve, right? If you have been stimulating the economy to the point where you've pushed it above trend and you've created this inflationary gap, and now you're trying to hit on inflation and bring inflation back down, how do you see the Fed juggling their dual mandate whenever you could have job losses in the face of some sticky inflation?
Well, that unfortunately is the consequence of their delay in tightening monetary policy, that they're being forced to catch up. And when you're forced to catch up, it means you eventually overdo it. Just as they overdid the easing, both in terms of scale and length of time, they're going to overdo it on the other side. And the problem is, and that's what creates boom and bust cycles. And this is not the first time that we're having to live through this. We did in the late 90s into 2002, the bust, and then, of course, in the mid 2000s, the boom and the bust in 07, 08, 09. And the Fed just is repeating the exact mistakes that were made then, and we're going to now have the bust.
Yeah, no, I share very similar to the same views, that the Fed being so far behind the curve. I have a couple of charts on that as well, because I wanted to ask you some deeper questions on that as well. If I come down here and just start with a really simple, how high can interest rates go? Because that's where they're ultimately going to have to fight this inflationary problem, right? And so you're seeing a chart here of the 2-year Treasury at, just a touch over 3. I think today it closed at 3.02 or something very close to that. And then you see where the Fed actually is at, the last 75 basis point hike gets them, to this 1.75 range, 1.5 range. Do you think they can make it to market expectations as they try to fight this inflation and try to land the plane, so to speak?
Well, right now, the Fed funds futures in middle of next year, call it a year from now, is pricing about a 3.5% end rate. I do think they'll raise 75 in July, which they made it pretty clear that they will. So that'll take them to 2.25, 2.5. Maybe they'll throw in 50 in September, get to 3. And I think by that time, there'll be enough of an economic slowdown and market impact that I'd be surprised if they went much further above that.
Yeah. Because then it's that analogy that I think I've been hearing everyone floating around, that quote unquote, something's going to break. I don't quite know what that something is. We've seen financial conditions tighten dramatically. And so far it seems to be an orderly sell-off. Would you disagree or agree with that?
I mean, whether it's orderly or not, we're down pretty sharply this year. So the rate of change year to date is not that orderly. The sharp slowdown in the pace of transaction in housing, you can say that is starting to break. For the average consumer who's living paycheck to paycheck and now can't afford certain things, well, they're starting to break. A break is not an event; it's a process, and the wheels are in motion in the response to both inflation and this rate rise. And it's not just rates; it's just quantitative tightening is just beginning. It will fully ramp up come September. That is another form of what I call asset price tightening, because it doesn't really have much of an impact on the real economy.
Right. And
well, indirectly it will, of course.
We've seen reserves come down dramatically, even though the balance sheet has really just now started to move, which has been really interesting to see that. I don't have a chart on that here yet, but another thing I've been thinking about as well, and you've mentioned it, that target rate at roughly 3.4, 3.5, That's not too far off from, what Bullard has been mentioning as his top rate for the federal funds rate. And there's also a really interesting correlation when you look at the misery index compared to the non-cyclical rate of unemployment or the natural rate of unemployment plus the Fed's 2% target. So you mentioned there that the consumer, of course, is already taking it on the chin. The housing market's already taking it on the chin. It sounds like it's going to be the scenario of inflation will be coming down, unemployment and job losses will be coming up, and the interest rate in the economy is going to be sticking higher, which is going to continue to elevate this misery index, even though they need to bring it back down below to actually call victory. Is that fair to say, or do you see it any different there?
The Fed, just as the Fed, up until they started to tighten, was solely focused on bringing down the unemployment rate at the cost of creating unstable prices. They now seem to be intent on creating stabler prices, because it'll take some time for it to be stable. Of course, that's not a word, at the cost of a rise in the unemployment rate. And back in the 70s, the misery index was just interest rates. It was inflation plus the unemployment rate. And the unemployment rate, all it needs to do is go to 5% from where it is now, and you'll likely be in a recession. So it's really, people need to focus on the trajectory of what is likely to come, and I think that is what is ahead. The question is what gets the Fed to buckle with their tightening, and will they stop before they reach their 2% inflation target because the unemployment rate is jumping and the economy is dramatically slowing, or will they just keep on tightening until they get to a 2% inflation rate? As nonsensical that 2% inflation number is, that obviously is their guiding light.
Could it be a situation where they move the target, that they come out and say, look, 2% was too accommodative and maybe 4% is more of the norm?
Well, that is very possible, which could happen, but that would be obviously a giant cop-out and a failure of their policy. But they may do that in order to try to defend weakness in the economy. That may be the sacrifice that they make, even though that is a very stagflationary, negative environment, I believe. But they've really screwed themselves, and it's going to be quite the juggling act to somehow get through to the other side without any pain involved.
Yeah, and I think Jerome Powell, as he's been doing his testimonies and at this ECB forum, he's talked about that there's going to be pain as they try to normalize and they try to catch up. And I think the forward guidance has been extremely interesting because they've provided it, the market's moved them there, and yet they haven't moved. Right? I think that's been extremely interesting. So talk to me then a little bit about inflation before we move on to market implications, right? So we know the Fed's going to be fighting inflation. I mean, do you see inflation peaking from here and rolling over hard because of the recession, or do you think inflation is going to remain sticky?
I think it will remain sticky, but goods prices, there are signs that they're beginning to roll over. We know that a bunch of retailers like Walmart and Target took on excessive inventories because they assumed the same consumer behavior over the last 2 years would continue, and that was obviously not the case. There's only so many laptops you're going to buy over a short period of time. There are only so many exercise bikes that you're going to buy in a short period of time. So they have to absorb that through lower prices. We're seeing a rollover in commodity prices, which I'm not sure how sustainable that is, but they are rolling over. The CRB Raw Industrials Index is at a 9-month low. So on the good side, we're going to see some easing of that inflationary pressure. On the flip side, services inflation is going to continue to accelerate, predominantly because rents are still rising pretty aggressively, and the CPI and PCE figures still are dramatically undercounting and undercalculating the reality in rent. So I think on a net basis, inflation's still going to remain rather sticky. The rate of change is definitely going to slow. The question is how quickly does it get to that 2% or under level that it really stood pre-COVID? And I don't think that's going to happen anytime soon. I wouldn't be surprised, though, if instead of an 8.5% inflation rate, which we're now sort of peaking out, give or take, that it slows to something around 4 by year end and something closer to 3 in the year after. But again, there's the cost of that is a slower economy, higher unemployment that we're going to have to absorb. But again, that's the situation we're in. Monetary policy can only affect the demand side, and it's taking with a hammer to the demand side of the U.S. economy.
Yeah, that's very, very interesting. And if I could pull up that chart of inflation real quickly, one of the things that I didn't put on the slide, but that I had here prepared for us was inflation during recessions. This slide that I'm showing here is that story that you had, durables versus service. Let me find my actual inflation slide itself. Here we go. So one of the things that I noticed was there was really only 2 meaningful periods of inflation and recession where we saw real hard reductions. So of course, the 07 and the 08 period, coming down from roughly 4.2% to negative 1.2%. And from March 2001 to November 2001, going from roughly 2.9 to 1.8. But the interesting thing was kind of this 80s period where you had to have 2 recessions to really drag down the inflation rate. Do you have to have a prolonged recession to get this one under control? Or do you have to have more of a mild one to get it under control?
It's really tough to say. I mean, the econometric models will tell you that you need probably an aggressive one, but we'll have to see. It's this is an unusual period because we're seeing synchronized global monetary tightening from what was the most extreme monetary easing that the world has ever seen in terms of the expansion of central bank balance sheets and negative interest rates, which we never really had in the history of interest rates. So what it will take to bring down this inflation, I don't know to what extent. I don't know if a sharp recession is needed. I don't know if it's just maybe a prolonged economic malaise that we see little to no growth or slight decline in growth for a longer period of time. In a way, a sharp recession is easier because you usually sharply rebound thereafter. A sort of death by 1,000 cuts type recession typically leads to a less robust recovery and could end up being worse. Like just look at Japan over the past 30 years. So I think it's really tough to answer that question.
Yeah, but that's a perfect segue into market implications, going from an extremely easy financial conditions to very difficult financial positions. I mean, when we look at some of the things like correlation in the market, and really you're only getting negative correlation in just a handful of things like commodities, oil, the dollar, gold flipping to somewhat of a positive correlation, treasuries being in positive correlation. And then when you start to look at like risk reward plots and you see that it's very defensive type leaders like dividend payers, lower volatility, or even when you're looking at the sectors, utilities, healthcare staples, how are you thinking about setting up portfolios, setting up positioning for periods where financial conditions are going to remain so difficult?
So it's not easy. We are trending towards, because our clients are mostly fully invested. So it's we do want to raise some cash, but it's more having value exposure, less so growth. Growth is going to dramatically underperform value looking at over the next 5 to 10 years. It's in fixed income. It's being short duration, high quality. I manage 2 portfolios. One's a global macro, and I'm in gold and silver. I still have some positions in some commodities, even though I've lightened up this year. and getting back to the value in that particular portfolio. I'm buying individual stocks, and I'm being very valuation sensitive and extending my time horizon on my ideas, because I know over the next year it could still be tough, and you got to have a longer term viewpoint on a particular business that you're investing in terms of whether it can weather the economic storm that's coming, and end up in a better place when we get out of it. And so it's not easy. And I think dividends are going to be an important part of one's total return when looking out, because I think the gains have been so extraordinary on the capital gain side the last 10 years that that'll be harder to replicate. And therefore, again, dividend yield is going to be a greater contributor to total return when looking out. So we're looking for companies that not only will pay a good dividend, but have a low beta business and will grow that dividend over time.
Yeah. Yeah. And how are you thinking about maybe things that aren't priced into the market then, right? So in your scenario, 99% recessionary environment, I was looking at a bulls and bears chart that another company produced, and it was showing and highlighting the difference between sell-offs without a recession and sell-offs with a recession. With the recession, it would imply that we've got more downside to come. Is that fair to say?
Well, it's fair to say, because what are the three things that drive stocks predominantly? It's the multiple that people are willing to pay, it's revenue growth, and then the profit margin on that, and what your earnings end up being. Well, most of the decline has been multiple compression, and if you go into recession, then you start to mark down your revenue estimates, and we're already beginning to see a pullback in profit margins, contraction profit margins, because of the sharp rise in costs, whether it's labor, raw materials, logistics, and so on. So yeah, that potentially is the next leg, is a markdown in earnings estimates.
And starting here in the next quarter, I would presume, because we've been at sky high record earnings estimates, and they've yet to pull those down. I assume you listen to lots of earnings estimate. Are you starting to hear that as you're listening to earnings calls and things of that nature?
Well, it's interesting because the sell side still hasn't really changed much their 2022 earnings estimates for the S&P. But I think in a couple of weeks, when we start to see earnings, that will begin to change, because that's when the real flood occurs. We haven't really seen it much yet, because only a few companies have a different fiscal year that have reported over the past couple of weeks. But I think you're going to see notable cut in earnings estimates as the rest of the year progresses.
Yeah. And I guess it would be on the back of those companies losing the ability to pass on these price hikes as the demand just continues to get pounded by higher inflation and tightening financial conditions.
Well, it depends who you are. General Mills, which is a stock we own, they had success in passing on higher costs. So it depends on who's got pricing power and who doesn't. But it's not just the cost. It's if the economy is slowing, you're going to take a hit on the revenue side as well.
Margin compression then at that point too, right?
Yeah, I mean, it's a triple whammy. It's falling multiples, slowing revenue growth, and a cut in your profit margin.
So definitely a not so rosy outlook. Is there anything on the horizon that has surprised you, or maybe is counter to your baseline case that we're going into recession? Anything that's showing a different signal?
Not yet. I think a positive would be if at some point China decided to fully reopen and accept COVID as just a way of life right now. That, of course, is not the case, but that would be certainly a positive for global growth if that were to occur. The world needs an unclogged Chinese supply chain. The world needs spending by the Chinese consumer. And until then, I think we'll still have global growth issues. But maybe after the Party Congress in October, they will pivot, and we can get a fully fledged Chinese recovery that is not start and stop because of COVID.
Yeah. Yeah. The zero COVID policy has been very interesting. And when I interviewed another guest of ours, and he was talking about inflation being a process, that you have to have something to get it started something to keep it going, and then something that makes it persistent. COVID being a zero lockdown policy in China, plus the Russian invasion of Ukraine, certainly accelerated the inflationary pressures we've already had brewing coming into this thing. So that's a really good point.
Well, keep in mind, the January 2022 CPI was above 7%, even before Putin invaded Ukraine. So we had an inflation problem before he did what he did.
Yeah. Yeah, absolutely. Peter, as we close here, I want to give you the final word on anything else that you're looking at, or anything else that you think is relevant to helping investors kind of get through this environment.
Well, in bear markets, those that win are those that lose the least. If you're going to be invested in markets, it's tough to avoid losing money, particularly now that bonds and stocks are falling at the same time. But on the flip side, bear markets create a lot of opportunities. It's better to be buying stocks in a bear market because they're marked down rather than having to chase things in a bull market. But in order to do that, you have to have cash, you have to have dry powder, and you have to be willing to bite your tongue when opportunities arise. And when you really don't want to buy something, typically is the time when you should.
Yeah. It's almost that hold your nose moment, as long as you've done your homework on the front end, right?
That's correct. Yeah.
Awesome. Well, Peter, again, I greatly appreciate you taking the time to come on here to give us your thoughts and your insight. Listeners, we're going to continue to provide you these updates and information as we get more information. So stick with us and continue to follow the channel. And Peter, again, thank you very much.
Thanks. I appreciate the invite and having me on.